Welcome to the Treasury Update Podcast, coffee break sessions presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. Welcome to another episode of the Coffee Break Sessions. Chatting with me today is Paul Galloway, Senior Advisor at Strategic Treasurer. Paul, always a pleasure to have you on. Thank you for joining us today.
Thanks for having me back again. Always a pleasure.
Absolutely. You know, the cool thing is we've had some great conversations, I think, in these past, probably 5-6 episodes that we've had around debt and capital and, some good takeaways, some good key nuggets around those particular subjects and really kind of diving into some specifics. And so one of the things that you and I actually kind of discussed is like, what would be a good one to kind of finalize this part of debt capital series, but really kind of to top it off. And I think that we couldn't close it out with any other better subject than to talk about debt market. I think it's an interesting piece. I'd love to get your insight and definitely educating myself as well as the audience around this particular topic. So let's jump right in to going into what is the debt market.
That's a great question. We spent some time here recently talking about the equity market and what it means to issue common stock, what are publicly traded stocks like, how they behave, why do you issue them? Well, we're flipping here to the debt side now. And so when you think about debt market, just like equity issuance, you have, or common stock, you have both sides, you have both players, people, or entities that issue common stock and investors that buy common stock as an investment. And it's the same thing in the debt market. So you'll have debt market, you have equity market. The debt side of things works just a little bit differently than common stock. Typically what happens when an organization wants to raise capital via debt instruments, they will go to their banking partners to work out the parameters for issuing debt. And so those banking partners have relationships with institutional investors. And so I specifically call out institutional investors because you and I couldn't go out and just buy issuance of senior debt from an organization. So let's just say, Amazon was, doing an initial issuance of senior debt. You and I wouldn't be able to go buy that. Doesn't mean that we can't own it in our 401k plans or our IRAs. There's a chance that we do own those bonds in our portfolios from the secondary market, meaning that the bond funds that we invest in, those portfolio managers have bought those bonds in the secondary market, if not at issuance in some cases, and it's part of the portfolio. So we can't go out and just get it like common stock. So common stock, on the day of issuance, you can go out and buy it. On the day of issuance for senior debt instrument, you can't go out right away and buy it into your personal portfolio. That's not something you can do like right away. So what happens is that the issuer will work with the banks and the senior managers, key senior managers, typically the CEO and CFO, will go travel around to meet with key institutional investors in what's called a roadshow, to pitch the issuance, to talk to them about their company and why it's important to raise the capital. And they're going to ask them, well, why are you using it? And there's various things that they can tell them. Sometimes debt issuance can be for specific things. And then sometimes they can just simply say, well, we're going to use it for general corporate purposes.
As you were talking about this, first thing I think about when we think about debt, right? That's a negative thing, debt's bad, right? And then situations when we think about, raising capital and investing and things of that nature, debt, it has some silver lining to it. And you mentioned that, you or I cannot go out and purchase these debt equities from these firms here. So who are the players in this market?
Typically the players are, like I said earlier, institutional investors. And so these will be a parameter of people. are groups of legal entities that are out there. So these could be other corporations that are interested in the bonds. It could be registered investment advisors that as part of their portfolio, they want to buy the bond. And so they'll be part of the offering. When you go out and you do the road shows, you get a sense of who's really interested in making an investment in the bonds or buying the bonds. And typically what you end up having happen is that they get what's called oversubscribed, and you want that. Why do you want that? You want that because if you're like 2-3 times oversubscribed, that means the demand's really high. What happens as an issuer, that can give you more favorable terms in terms of the yield that you pay on the bond. So you could get a better deal versus if it was like 1 to 2 times in between there. That means that the appetite's not quite as good. And so you got to pay a little higher yield to ensure that you get or raise the full amount of the capital that you want to raise. Even though the subscription is, let's say 1.5, 2 times, it doesn't mean that all those investors ultimately subscribe to that. It's one of those things where the institutional players, when it comes to bond funds, and these are things that you would see in your 401k or IRA, those bond fund managers have an interest in getting these bonds. And if they can get them at, issuance, the primary market, they will if they're really interested in that company and the issuance is coming out. Otherwise, they may trade those through the secondary market.
So you brought up some good points there. You actually leads into the next question I do have. You were talking about analyzing and monitoring these markets and what to do. So this question is going to be kind of twofold. So part one of this question I want to ask you is kind of on the issuer side of things. So how do issuers monitor debt markets, and why is it important to know what's really going on?
Let's put on our treasurer cap. So treasurers of companies typically are involved in capital raising. And what's important for them is to see what's going on out in the markets. And so what they'll do is they'll look at several things. They'll look at, okay, what are the underlying benchmark rates? What are they doing? So it could be for floating rates. It used to be LIBOR that you would look at, but LIBOR's gone away. And so now in the U.S., we're looking at primarily SOFR is the one that seems to have risen to the top. That's a secured overnight funding rate. That's SOFR. And so that's a floating rate. And then you have your benchmark rates like treasuries. So for fixed coupons, you typically benchmark that off treasury. And so that's important from an issuance standpoint, because when you go to issue anything out there, there's 2 components to the rate that you pay on that issuance. One is the underlying benchmark rate, which is fixed or floating. The other component is spread. Spread is based on perceived credit risk that's out in the market. And so you pay the underlying benchmark plus a spread. And that's what you pay for your rate. That's what your rate ends up being. And so that spread component, like I talked about, based on credit, what treasurers will do is they'll go out into the market and they'll see how bonds are trading for competitors, especially around new issuers that are of similar credit quality. And so that will give them an indication of where they think they should trade. Plus, they'll look at their own bonds and see how their bonds are trading down the market today, ones that they've issued before. And this will give you a view of what cost should be, what it should look like. And so they're constantly monitoring that to understand where things are at. So from a planning perspective, looking out not just the next 12 months, but going out 3, 4, 5 years, they're looking at what potential costs might be. So they go out and they monitor all these different components that I just talked about to determine what things might look like. And that gets more refined the closer they get to the point that they start considering, hey, I want to raise some capital. And it could be, something that's like a senior type deal, or something that's maybe contingent in nature, or a revolver, things that are set up to backstop and fill gaps or emergencies. It's important for treasurers to continue to monitor the debt markets, both for secondary offerings new offerings in their industry at their credit qualities.
So on the flip side of that, so let's talk about from a investor perspective, right? So kind of the similar question. This is part two of that first question I asked. How do investors monitor the debt market, and why would it be any different from an issuer's point of view?
Yeah, so bonds behave a lot different than stocks. So stock trades on a variety of components, such as revenue, earnings. Earnings is a huge component to how stocks trade, perceived future earnings, dividend yields, products, services. It can be things that are qualitative and quantitative that impact common stock. With bonds, so this would be debt issuance. A debt issuance is a bond. Bonds trade based on interest rates or yields. And so as yields move, and so what a yield is, think of it this way. I issue a bond at 5% and has a par value of 100, meaning assume that its price is, per unit for the bond is 100. That's the price of the bond. And I issued it at 5%. What happens out in the markets is, so initially when you issue it, just excluding everything else, just holding all that constant right there, what I told you, the yield on the bond at time of issuance is 5%, ignoring anything else. I'm making this real simple. But what happens is after you issue it, there's all kinds of things that are going on in the markets. Spreads are moving. So spreads, that one component I talked about earlier, credit risk, that moves all the time, moves every day, moves during the day. So spreads are moving. Interest rates can move, meaning the interest rates, let's say you issued a 5-year bond, the underlying benchmark was a 5-year treasury. Well, 5-year treasury yields move. So you got that moving. So you got the underlying benchmark moving, you have the spread moving, so that yield can go up and down. If the yield goes up, let's say the yield goes above 5%, what happens to that baseline price of 100 is the 100 goes down. Let's say it goes down to 99. It moves up, it goes down to 99. It's higher than 5%. The yield is now. That means the yield's higher than the coupon of 5%. The price is lower than the 100. But let's say the yield does the inverse. The yield goes below 5%. That price then of the bond goes up. So now per unit, it's worth more than 100. Let's say it's worth 101. If I'm a trader, I perceive that yields are going to increase and have a bond that, maybe I'm really not really jazzed about much anymore. Its prospects given the way markets are moving. And I think it's going to move against me, and I think I can get a better return with another debt instrument or another bond. I may sell a bond that I perceive is going to go against me, meaning that the value of the bond or the yield's going to go the wrong way. So I may sell that bond. And I may buy into a bond that I think, hey, the yield's going to go a direction that's going to be more favorable to me. Investors will monitor the market to see what yields are doing so they can look at their overall portfolio and what's going on in the markets with that particular bond and make investment decisions based on that.
Well, I tell you what, the debt market conversation is that was pretty intense as far as just a different way of looking at ideas and ways for organizations to raise capital in a different way, and definitely for investors and how they can find that great return on investment as well to the bonds. So again, thank you for joining me today, Paul. I really appreciate it. For our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or feedback, please send us a note at podcast@strategictreasure.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.